possible to have a champagne problem and, well, a hangover at the same time? One AI infrastructure darling seems about to find out, and it's making for some really fascinating conflicting signals. Welcome to D-Risk, a podcast where we provide a no-nonsense analysis of stocks. Today, we're diving deep into Nebius Group, ticker NBIS. This deep dive is based on our research data captured September 4th, 2025, around 7:46 a.m. Eastern, to unpack exactly what is going on here. Okay, let's unpack this. Maybe start with the big picture, the macro environment. Pre-market futures are giving tech stocks a bit of a cautious nod right now. A glimmer of hope, maybe, but honestly, you go pull back. The broader economic news feels like a giant flashing yellow light.
It really does. It's a stark contrast, isn't it? You've got economists, Moody's, UBS, using words like stall state, even a recession risk. They're pointing directly to, weak consumer spending, slowing labor demand, and adding to that anxiety. Today's calendar is just packed. Jobs numbers, services reports. It feels like the market's holding its breath a bit.
Right. So in that kind of climate, how much does being in a red-hot sector like AI actually, protect a company? Because Nebius Group is exactly that, building the backbone for AI globally. Yeah. But its story right now, wow, talk about whiplash. Just yesterday, the stock took a 5.1% hit.
Ouch.
Yeah, after slightly missing Wall Street estimates. Profit and revenue, kind of a party pooper after such a great run.
It really is. And the irony, this stumble comes right after the stock soared, over 25% in August. That was driven by management massively boosting its revenue forecast for the year. They projected a run rate between $900 million and $1.1 billion. Plus, they're quadrupling global data center capacity. Huge commitment.
And the Wall Street analysts, they seem firmly focused on that long game. All five covering the stock rated buy or strong buy. Consensus price target around $70.80. And some valuation models, just based on earnings potential, put fair value way up there. $1,189 a share. Can you believe that?
It's astronomical.
So the question isn't if they're bullish, it's why the market punished them so hard for just a slight miss, when the long-term picture looks so rosy.
And this raises, I think, an important question for you listening. Is yesterday's miss just a tiny speed bump on this highway to growth management seas? Or perhaps it's the first subtle sign of engine trouble? Maybe hinting at, how the market feels about the whole AI boom right now.
That's a critical distinction. Okay, so the pros paint a bright future, long term. But what's the immediate word on the street? What about the traders moving the stock day to day? Same vibe?
No, definitely a different vibe there. Traders are showing some serious skepticism. Look at the options market. The put-to-call ratio is 1.2.
Meaning more bets on it falling than rising?
Exactly. For every 10 calls, there are 12 puts. It signals pretty strong bearish sentiment, near term anyway, and you can see these sort of battlegrounds clearly drawn. The $71 strike price looks like a potential ceiling, lots of contracts there, and maybe $61 as a potential floor. Plus, nearly 8% of the company's float, the available shares, are being shorted. That's a notable chunk betting on weakness right now.
Okay. Analysts bullish, traders bearish. So with all these conflicting currents, how's this actually playing out in the price charts? Let's look at the technicals.
Right, drilling down there. It gets interesting. From a trend perspective, yeah, the long-term picture still looks healthy. Months of upward movement. But short-term, that's a different story. We've seen a clear reversal since, say, early August. Lower highs, lower lows. Classic signs of a downtrend starting.
And volume. Is money flowing in or out?
Volume indicators suggest buying pressure has definitely given way to selling pressure. Money seems to be flowing out. And momentum gauges, also showing a decisive downturn. That powerful upward force has faded. Volatility has calmed down, though, which might indicate it's consolidating, sort of catching its breath after that wild ride.
Okay, so putting it all together, the macro worries, the earnings miss, the analyst love, the trader doubt, the technical weakness. What does this mean for you today? After synthesizing all the data from our research, our verdict is a wait-and-see approach.
Yeah, the logic seems pretty clear. You've got this spectacular long-term fundamental story, a very bullish analyst, but that's clashing head-on with a negative macro backdrop, that fresh earnings miss, bearish trader sentiment, and those weakening short-term technicals. It's like the bull case is a marathon, focused on future potential. But the bear case, that's a sprint focused on right now. And, well, right now the sprinters seem to have the lead.
So for your game plan today, definitely watch these levels closely. The stock's trying to find its feet, maybe around $65 to $66 pre-market. A key line in the sand downside, yesterday's low, $64.83. If it breaks that, the door could open towards $61.
And upside.
To flip bullish today, Nebius really needs to reclaim yesterday's high of $67. Then you might start looking towards that 71 dealer ceiling again. Ultimately, Nebius feels like this classic battle between a potentially brilliant future and a currently bruised present. But I guess the question for you today is, do traders have the patience to look past that black eye from yesterday's report? Or does the short-term pain win out? That's all for this deep dive. Remember, this podcast is for informational purposes only and isn't financial advice. Do your own research or consult with qualified financial advisors before making any investments. Thanks for tuning in. Catch you in the next episode.